All right. Hey, everybody. We're back again with episode 28 of the MAREI PartnerCast. We have a really good interview today here with Erik Oliver of Cost Segregation Authority. And I've worked with Erik before. He's been really helpful on some cost segs that I've had done. So you guys are going to really enjoy this video here and have him walk you through all the details of it. Thanks for joining us, Erik.
Yeah, no, thanks for having me, John. I appreciate it. Glad to be here.
Sounds good. So he's going to go through, it's going to be a little bit different format. I usually ask questions and whatnot, but this has all the answers and questions in it already. So he's going to run through a little PowerPoint here. And then if there's anything else, obviously he'll provide his contact info at the end. So go ahead and take it away, Erik. And if there's anything you need, just definitely ask.
Okay, perfect. Thanks, John. Well, yeah, I would just like to thank you guys for having me again today. We're going to talk a little bit about cost segregation and some of the new benefits around cost segregation. A lot of you guys have probably heard of it or maybe even implemented it in your investment strategy. So we'll touch on it slightly here in the beginning, but I do want to kind of touch on some of the changes that have happened recently with not only the coronavirus or the CARES Act, but also some of the things that changed during the Trump tax changes. So we'll go ahead and get started. Cost segregation, it's probably one of the most or the least utilized tax savings tool out there that I know of. I'm surprised at how many times we meet real estate investors who haven't heard of cost segregation, who are not using it. And so that's kind of our goal, is just to get out, share the word with you guys. Like I said, we're going to talk about some of the aspects of the new Tax Cuts and Jobs Act, and then again, the coronavirus or the CARES Act that has really put this stuff on steroids and made it very powerful for real estate investors. So it all kind of builds on each other. Cost segregation has been around for a number of years. And really, cost segregation is just accelerated depreciation. And it's done through an engineering-based study. And most of you guys know that you can take depreciation on your real estate assets, and we just want to accelerate that through cost segregation. So that's kind of the foundation that's been around for a number of years. We'll touch on that here in a second. Then we had the Tax Cuts and Jobs Act. That's the Trump tax plan. And with that came bonus depreciation. And we'll touch on that as well. But bonus depreciation has really put this stuff on steroids. It really speeds up even faster the accelerated depreciation that we were already taking with the cost segregation studies. And now with the CARES Act, this coronavirus stimulus package that recently passed, we can now carry these deductions back and recover taxes that we had paid in previous years. And we'll kind of touch on that and see how you guys can, it's basically, you're getting a refund check from the government for taxes you paid all the way back in 2013, 14, 15, and so on. And a great way to increase cash flow during these hard times. So we'll touch on that as well. So really, most of you guys know what depreciation is, but depreciation is basically a tax deduction or a paper loss that you get to take against your real estate. So the IRS says if you have a residential rental, you get to depreciate that over 27 and a half years. Or if you have a commercial property, you get to depreciate that over 39 years. So just to make the math simple, if you have let's say a residential duplex that you bought for $275,000, you get to take about a $10,000 write-off every year for the next 27 and a half years. And that $10,000 write-off it acts just like an expense. It comes off your taxable income. And that's why a lot of us get into real estate. So when you have these real estate holdings, you lower your taxable income by using the depreciation on your real estate assets. And so what we say is, instead of taking 1/27th every year for the next 27 and a half years, what if we take 30% of our deductions in year one and spread the rest out over 26 and a half years? And there's a number of reasons why we would do that. You know, you've got the time value of money. A dollar today is worth more than a dollar in the future. And it actually helps reduce the amount of taxes you pay when you sell the property. And we'll kind of walk through that here in a second too. But again, the way that's done is we will go into your property and we will identify the short-term assets. So what I mean by short-term assets is the IRS has stated in their depreciation books that carpet should be depreciated over 5 years, for example. Cabinets, countertops, those are all 5-year assets. So we come in, let's say you buy a building today, You do a cost seg study. We'll come in, you buy it for, let's say, $300,000. We come in and say, instead of depreciating that $300,000 over 27 and a half years, let's segregate or identify the short-term assets and put them into the right categories. So we come in on that $300,000 purchase and we'll say, okay, of that $300,000, 70,000 of that is short-term 5-year assets, things like carpet, countertops. And that's what we do, is we put values to those carpets, because you guys don't know when you buy a property what the existing carpet is worth or what the existing cabinets are worth. And that's why you would partner with a cost segregation company to come in and identify and put a value to those things. And so that's really how cost segregation works in a nutshell, is we're coming in and segregating your building into different pieces and different parts, putting values to those parts, and then you're able to depreciate them at a much faster schedule than the typical 27 and a half or 39 years. Sometimes we get asked, is this a tax loophole? No, it's not a tax loophole. This is actually a quote from the IRS audit guide that says it's desirable for taxpayers to maximize personal property costs in order to accelerate depreciation deductions and hence reduce tax liability. And so we've actually seen depreciation kind of in the news lately with the release of Trump's tax return, saying that he pays, $750 or whatever it was in taxes. And a big portion of his tax strategy is using the depreciation that he has on his real estate assets. So it's not illegal, it's just using it smartly, and using it smartly, I don't know if that's a word, using it wisely, I guess, and being able to have the right team around you who's advising you and say, okay, why are we depreciating our asset why are we depreciating our carpet over 27 and a half years? It's in the IRS code that we don't have to do that. So let's accelerate it and let's take our deductions now versus letting the IRS hold on to them for an extended period of time. So again, I kind of mentioned the different categories here. We come in and we will identify the personal property from the real property. And so your personal property is that column over there on the right, things like carpet, countertops, cabinetry, blinds, auxiliary lighting, specialty plumbing, etc. So those are basically anything that's not screwed down or part of the structure on the inside of the building. And then we also have the outside of the building, or the land improvements. These are your 15-year assets, things like parking lots, asphalt, curbs, gutters, sidewalks, storm drains, irrigation systems, retaining walls, trees, shrubs, and landscaping. We'll go out and count the trees on the property, because trees, according to the IRS, are a 15-year asset. So we'll put a value to those trees and depreciate them over 15 years versus the 27 and a half or 39 years. Everything that's left over is your structural property, your real property. Those are things like the steel structure, the roof, the walls, windows, HVAC system, plumbing and electrical, all the structural parts of your building. And typically when we do a cost segregation study, we will segregate out about 30% of the building value into shorter asset lives, either 15 or 7 or 5. And so again, that's where you're getting a 30% bump basically in your first year on some of these properties. And we'll walk through a case. Actually, here's the case study here. So let's talk a little bit about a residential assisted living home. Cost $1.2 million. They bought it in 2019. The current tax year is 2019. This is prior to the tax law. So, well, the tax law took effect in 2017, but at the end of 2017. But I want to show you what cost segregation would have looked like before the tax law, and then kind of show you what it looks like after. But the items we reclassified, your 5-year stuff, we went in, identified these things, put a value to them, looked at the exterior, put a value to that stuff. And we basically come back with a new depreciation schedule. So I know there's a lot of numbers here, but kind of be patient with me. We'll walk through these. Over on the left-hand side, you'll see that you've got depreciation without cost segregation. So that's your standard deduction. That's what a lot of people end up doing. They buy this property for $1.2 million. They take their closing statement, give it to their CPA at tax time. Their CPA puts this on the depreciation schedule as one big asset for $1.2 million, depreciated over 27 and a half years, and they get a $43,000 write-off every year for the next 27 and a half years, which is great. You know, that's $43,000 off your taxable income every year that you don't have to pay taxes on. With a cost seg study, we've identified, if you look across the bottom there, you'll see under the 5-year category, we identified about $216,000 worth of 5-year assets, $12,000 worth of 7-year assets, and $96,000 worth of 15-year assets. So now you get to take that $216,000 and you get to depreciate it over the 5 years, which is much better than depreciating it over the 27.5 or 39 years. And then you've got your 15-year assets, your 96,000 that you get to depreciate over 15 years. When you spread these out over shorter periods, you can see this is spread out over 5, 7, and 15. These are your depreciation amounts over here now. So in the first year, instead of taking 21,000, if you didn't do a cost seg study, you now get 65,000. That's an increase of $43,000 of additional deductions. At a 35% tax bracket, that's a $17,000 tax savings. And then you can see the second year is really where the big bump is on this example, because you get 113,000 of depreciation versus 43. And again, that's a $69,000 increase or a $27,000 tax savings at that 35% tax bracket. So you can see that by accelerating your depreciation, you're getting much larger write-offs up front. And I've got a, whoops, let me go to the next slide here. Oh, hold on one second. Let me clear my, there we go. Whoops, clear. All right, so now if we go to the summary here, what that does in your first year, like I said, is a $43,000 of increased depreciation or a $17,000 tax savings. Over 5 years, you'll get $196,000 of increased depreciation or a $70,000 tax savings. And so you can see how powerful this stuff was before the bonus depreciation, before the Tax Cuts and Jobs Act. We still were doing a ton of cost seg studies and, you know, increasing the depreciation and shortening the depreciable lives on some of those assets. Let's quickly talk about one question we often get asked is, does this only work on new properties or properties that I haven't already put on a tax return? And the answer is no. You can actually do this on properties that you've owned for, let's say, 4 or 5 years. So for example, I bought a property in 2014, but I just learned about cost segregation, or I have a big income year and I want to take some deductions. You can actually go back and do what they call a catch-up or a look-back study and take the deductions from 2014 and apply them to your current tax return. And there's a form that has to be filled out to do this. It's a 3115 tax form. We provide it as part of our services for you and your CPA. But basically what you're telling the IRS with that tax form is, hey, I've been taking my straight line depreciation. I want to accelerate it now. And here's the difference in those numbers. And so let's look at that same example, $1.2 million property. All this depreciation here in this red circle, you get to take that in the current year. And that second red circle there is your difference. So you've got about a $203,000 difference in the amount of depreciation you took versus the amount you were eligible for under the cost seg. And you get to take that $203,000 in your current year. And so that's a huge benefit. If you've got a big tax year and you're sitting on properties and you're paying, you know, at the higher tax rates, definitely worth looking at doing some cost segregation work to lower your taxable income and save, in this example, $81,000 worth of taxes. So again, you've got a $203,000 increase in depreciation. Take that times a 35% tax bracket. That's an $81,000 you're paying. Just to give you an idea, a study on this type of property is probably going to cost you $4,000, and you're going to save 81. And so, you know, huge returns on your investment. Doesn't require an amended return. You don't have to go back and amend your 14, 15, 16, no, none of that. You just get to take that deduction on your current tax return by filling out that form. So great opportunities there. Here's a quick case study on a residential rental. Let's say the acquisition cost, this is the same type of scenario where you bought it in 14, you paid $285 for it. The current tax year is 19. Again, you go in, you take those deductions amounts from 14, 15, 16, 17, and 18, and you drop it on the current tax return. In this example, that's $48,390 of additional deductions, and that equates to about a $19,000 tax savings at that 35% rate. So it works on small properties. There's some misinformation out there, I feel like, or I don't know if it's misinformation, but in the past, cost segregation did only apply to the larger properties because for two reasons. One, the fees were a lot higher than they are now. And two, we didn't have all this bonus depreciation and stuff that's available to us now, which we'll get into here in a second. And so in that instance, you had to have $1 million property for this to make sense if the study was going to cost you 12 grand, because you would need a return on your investment. But nowadays, we do a lot of single family rental homes where people are getting $10,000, $15,000 of tax savings in the first year. It might cost them 2 grand to do the study. And so again, good return on your investment. So when would you do a study? We talked about if you currently own an income property, any revenue generating property, if you purchase an existing building or build a new building, if you renovate, remodel, or make leasehold improvements to a building, before you sell a building, which we'll kind of walk through an example there because that's hard to grasp, because when you sell your assets, you have to pay your depreciation back. And so people say, well, why am I going to take all my depreciation up front if when I sell it, I have to pay it all back? And we'll get into why you would do that. There's a time value of money element. There's an element where you take your deduction today at a higher rate and pay it back at a lower rate when you sell, and you get to keep that float, that difference in tax rates. And so we'll kind of touch on that. And then the last one is if you have a step up in property. So let's say you inherit a property either through a family member or a business partner, there may be an opportunity there as well. All right, so let's talk about the sale of an asset. When you sell a investment property, you pay 2 types of taxes. You pay a capital gains tax and you pay a recapture tax. And so again, why people always say, well, why do I want to accelerate my depreciation? Because the recapture tax is paid on the amount of depreciation you've taken. So why do I want to accelerate this if I just have to pay it all back? And again, one reason is the time value of money, cash flow leverage. Let's say you take it today and you have to pay it all back 10 years from now when you sell it. You basically are getting an interest-free loan from the government that you would have to pay back in 10 years. But the actuality is you don't have to pay it all back. You only pay a portion of it back at a lower rate. And then you get to keep that difference. And that's a permanent tax savings. And we'll kind of walk through that here. So I know there's a bunch of numbers here, so I don't expect you guys to fully understand this slide here in the next 3 minutes. But the whole idea is that, well, let's talk about this slide quickly. So this is a cost segregation, or this is the sale of an asset without doing a cost segregation study. So you can see that you buy a apartment complex in 2012, you sell it in 2017, so 5 years later, and you sell it for 3.3 million. Bought it for 2.5, sell it for 3.3. So you made 800 grand on it, right? You do have to pay taxes on that 800,000. And in this example, your taxes would be 285,000. That's the number in the bottom right-hand corner. So again, bought it for 2.5, sold it for 3.3. On that $800,000 gain, you have to pay a portion of that is recapture tax, and a portion of that is, excuse me, let me go back. A portion of that is recapture tax, and a portion of that is your capital gains tax, and that totals 285,000. Typical real estate transaction happens all the time. They're happening all over today in the country right now. All right, so now if you do a cost segregation study, it's the same principle, and I know that, again, there's a lot of numbers here, but the idea is now we've segregated these items into 5-year, 7-year, and 15-year assets, right? Still got the original purchase of 2.5, but now we've segregated 425 of that. Sorry about my circles here. These are trying to do this with a mouse. These are awful circles, but on my 5-year assets, we've segregated $425,000 worth of the 2.5 million. So we started with 2.5 million. I said on that 2.5 million, 425 of that was 5-year assets. Now let me ask you guys a question. What are my 5-year assets worth after holding this building for 5 years? They're worth 0. What's that box there? They have 0 value, right? They're fully depreciated. So a lot of CPAs we work with say, I am going to pay 39% recapture on 0. In this example, I did put a 10% valuation. You see up here in the top left, I put a 10% valuation on my 5-year assets and said, my carpet and my countertops that were in that building when I sold it, they did have some value. They had 0 book value, but they did have some value. So I'm going to pay a recapture tax on 10% or 42,000. So when all these numbers flush out at the end of the day, Your total tax bill now is down here in the bottom right-hand corner, $203,000. Remember, it was $285 on the other page. And so now we've got a tax savings of $81,000. And so the whole idea, like I said, I know there's a lot of numbers here, but the whole idea is you're not going to sell your 5-year assets for more than you bought them for 5 years prior. And what happens if we don't do cost segregation and we bought our building for 2.5, we hold it for 5 years and we sell it for 3.3, you're saying that everything in your building went up in value by $800,000. You're saying your carpet is now worth more than it was in 2012. Your cabinets are worth more, your land, your walls, your HVAC, you're saying everything went up in value. And the actuality is that our 5, 7, and 15-year stuff all goes down in value. Your carpet isn't worth more today now that it's dirty and stained than it was 5 years ago when you bought it, right? It's worth zero in this example. And so you shouldn't be paying as much recapture on that. And so by doing cost segregation, it allows you to manage the allocation of the sales price to the right buckets, I'll say. And again, at the end of the day, you're paying $81,000 less on this same example by doing a cost seg study. So you get the deductions up front, you get to use that money to reinvest, and then when you sell it, you do pay some of that money back, but you're going to pay it back at a lower rate on a lesser amount, I guess is the kind of the moral of the story there. So that's why people will call us when they say, hey, I'm about to sell my $2 million apartment complex. I've owned it for 7 years. Can you do a cost seg study? We'll do the cost seg study, identify all these different categories, and then help them manage their recapture tax and save them, in this example, $81,000. Let me go to the next slide here. I just have to clear these. And close that. There we go. All right. So that's cost segregation 101. So let's talk a little bit about how the Tax Cuts and Jobs Act of 2018 has impacted this. So the main thing is bonus depreciation. I don't know if that's a term you're familiar with or not, but basically the IRS is giving you extra deductions in the first year. And this law has been around for a while, this bonus depreciation. Couple caveats, they used to always change the bonus amount depending on how the economy was doing. If the economy was doing great, then they would lower the bonus amount. If the economy was doing bad, they would increase it. 1 year there, we had 100% bonus. But basically what this is saying is that you get to take 50% of your depreciation on your short-term assets in the first year. So you're taking a big deduction up front and spreading the rest out. Now, when they came up with this bonus depreciation, I don't think they thought about real estate because they added this, that it had to be 20-year property or less. So they're saying, the IRS is thinking, well, real estate's a 27.5-year asset, so this doesn't apply. Well, what if you do a cost seg study and all of a sudden you have 5-year items, 7-year items, and 15-year items that are all less than 20 years? Now, all of a sudden, you can take this bonus depreciation on those items. Under the old tax law, the other thing that was hindering was that it had to be new property. And so let's say you built in 2016, you built a new duplex. We would come in and do a cost seg study on your new property, and any of the 5, 7, and 15-year stuff that we identified, you would get this 50% bonus. But it had to be new construction. And so that eliminated a number of people who were buying existing construction. Well, with the changes to the Tax Cuts and Jobs Act, a lot of this stuff went away, and they actually made it much better, which makes sense because, your president happens to own a lot of real estate. And so when he was writing the tax bill, he said, hold on, I got a lot of real estate friends. Let me make this real enticing for those guys. And so what happened is the depreciation went from 50% to 100%. And that is very important, 100% on anything purchased between 9/27 of 17 and 12/31 of 2022. The other thing he got rid of was it no longer has to be new property, which again is huge because now I can go out and buy a home that was built in 1980 for $200,000, have a cost seg study done. Anything that's identified as 5, 7, or 15-year assets, all of a sudden, I get to write it off 100% in the first year. So again, huge changes that made a significant impact for real estate investors is you now get 100% of your deductions in the first year. Not on the structural stuff, just on the 5, 7, and 15-year stuff. But again, it's eligible now on existing buildings. So let's take a look here at at what this does on a property. Let's go back to that $1.2 million residential assisted living. Now, under the new tax law, remember those 5, 7, and 15-year categories that we had identified? There was 216,000, and it was kind of spread out over 5 years. Our 12,000 was spread out over 7, and our 96,000 was spread out over 15. You now get to take that 216,000 in the first year because it's a less than a 20-year asset, and it's 100% bonus. You get to take this in the first year. You get to take this in the first year. So now all of a sudden, you've got this massive deduction in the first year. You still have a significant deduction going forward. You know, you've got 31,000 here. You would have got 43 had you not done the cost seg study. But the idea is I'll take a little bit in year 2 through 26 and a half, but give me the 339 right now up front. Because I want to take that tax savings of 127,000 and I'm going to go buy myself a new duplex or a new fourplex or put it down on multiple single family rentals or do what you want with it, right? But give me my money now. And so in this example, same example, you've now increased depreciation by 318,000, resulting in $127,000 tax savings. Literally, John, we're creating deductions now that people cannot use. They're like, I don't make that much money. You know, I don't need all that deduction. And there's ways we can manage it. The IRS knew that was going to happen. They said, okay, you know, let's say I only make $150,000 of taxable income every year. I don't need a $318,000 write-off. And so what a lot of investors will do, and what the IRS allows us to do, is say, I'm not going to take bonus on my 5-year assets or my 15. I'm going to divide that up over 5 years, divide that up over 7, but I am going to take bonus on my 15-year assets because I'm not even going to own my building for 15 years like that. So give me those deductions now. So there's a lot of ways to manage these deductions, and we work with your tax preparer to make sure we're maximizing the amount of tax savings, but you have a lot of deductions available to you if you purchase properties within that time frame. And remember, that time frame is anything purchased after November 27th of 2017, and it's currently on the books until the end of 2022. Now, I know we have an election here in a couple of weeks and things may change, but currently, any properties bought between September 27th of 17 and December 31st of 2022 are eligible for this 100% bonus depreciation. So, you know, that could be, whoops, let me go back here. Could be very advantageous to you if you are paying taxes and own real estate. It's really worth looking at your portfolio to say, you know, does cost segregation make sense and how can I utilize it? This is the same example. This is a $500,000 fourplex with bonus. And you'll see that in this example, we've increased depreciation by $132,000 for a $53,000 tax savings. That's on a $500,000 property. So significant numbers there. All right, so now we've kind of talked about cost segregation. We've talked about the Tax Cuts and Jobs Act and bonus depreciation and how powerful that's been. Now we've got this CARES Act, and part of the coronavirus package that came out, which was the CARES Act, was a 5-year net operating loss carryback. And remember how I just talked about how we're creating deductions now that people can't use. In the past, if let's say I had $150,000 of taxable income, I do a cost seg study and I create $350,000 of deduction. That extra $200,000 of deduction, you don't ever lose it. It just moves forward into next year and offsets my taxable income for next year, which is great, right? You just create these deductions, you keep them on the books, and you just move them forward, and you don't pay taxes on your rental income going forward. Well, under the CARES Act, they reinstated the 5-year net operating loss carryback, which now says, instead of carrying those extra deductions forward, I get to carry them back to taxes that I paid 5 years ago. And so now I actually get a refund check immediately versus having to wait to utilize my deductions in future years. And the whole idea was, let's get money back into our investors' hands now when maybe they have tenants who have been impacted by coronavirus, they're not paying their rent. Let's get money or cash flow back into our investors' hands now versus making them wait for future years. And so kind of how that works is, I've got an example here. Let's say, this is a great example. I have a client who had 100,000 of taxable income in 2020, right? So after all their expenses and stuff, they're going to be taxed on 100,000 of income. But let's say they have 4 or 5 properties and we do cost segregation studies on those 4 or 5 properties, and we create a $525,000 deduction. So we create this $525,000 deduction. They have 100,000 of income. Well, the first thing we're going to do is wipe out this 100,000 of income, right? So now they've got $425,000 left that they, in the past, would have to carry that 425 forward. So next year when they make 100,000, they would wipe that out. They'd have 325 to carry forward and so on. Now we get to take this back 5 years and recover taxes paid in previous years. So I've got this 425,000 sitting here. Back in 2015, I had 75,000 of taxable income, and I paid 14,000 in taxes on that income. Well, now I'm going to take this 425,000 and I'm going to wipe out that 75,000 of income, and I'm going to recover that $14,000 in taxes. So now after I wipe out, or after I use 75,000, I now have 350 left, and I'm going to offset this 150,000. I'm going to recover these taxes here, and so on until you fully use up this 425,000. So in this example, 100,000 of taxable income, do some cost seg work. We've got 525,000 of deduction now. I'm recovering all these taxes over here, and I'm getting a refund check from the government for 115,000. I don't have to amend any tax returns. There's, I think they call them quick claim forms that you just need to submit with your taxes, but you're basically saying, I've got this 5-year net operating loss carryback. I'm going to go back and get taxes I paid in previous years. Now, this does only apply, I want to make this clear, this does only apply if you classify yourself as a real estate professional on your tax return. If you don't classify yourself as a real estate professional on your tax return, these extra deductions would carry forward, which is still a good thing, but you don't get the instant cash back from the government on the net operating loss carryback. So anyways, there's rules on what qualifies you as a real estate professional, but if you do file your real estate, or excuse me, if you do file your taxes as a real estate professional, you or your spouse, and you file a joint return, all of a sudden this is eligible to you. Now the great thing is what were the tax rates back in 2015? They were a lot higher than they are now, because that was before the Tax Cuts and Jobs Act. And so we're going back and getting income that might have been taxed as high as 39%, and we're getting that tax money back. And so good opportunity if you need cash flow, if you're paying taxes, and you've got properties you haven't done cost segregation work on, create a deduction in 2020 and go back and get money from previous years. Now, I will say 2020 is the last year you can do that currently. So I think it expires at the end of this year. There's some talks that they may extend it depending on how this coronavirus thing all shakes out. But right now, your 2020 tax return is the last year you'll be able to do that. So, and you can actually go back and amend 2018 and do this same strategy. And that would allow you to go back as far as 2013 to recover taxes. So it's eligible for 2018, 19, and 2020 taxes. So again, if you've got these big tax years in 15, 16, 17, or 18, you've got properties, it may be a good time for you to go create a big refund check. All right, I think that, let me clear this off here. All right. So that just kind of brings us back to this diagram here, but basically we've talked about all three of these now. You've got your cost segregation as the foundation. The Tax Cuts and Jobs Act has put basically, and now we've got the CARES Act, which allows us to take these huge deductions that we're creating with the bonus depreciation, and allows us to go back and get taxes paid in previous years. And so hopefully I kind of walked through that and made that clear on how to do that. Whoops. If not, this is my contact information here. This is actually my cell phone number. Feel free to give me a call if you guys have any questions on depreciation, cost segregation, the Tax Cuts and Jobs Act. Our firm is kind of a niche firm. All we do is cost segregation work. We don't do tax returns or anything else. So we're very knowledgeable about depreciation and not so knowledgeable about child tax credits and earned business income and these other subjects. But if you have any questions on depreciation, definitely feel free to call me. We do a free benefit analysis before we ever engage a client. And so if you've got properties and want us to run some initial numbers to say, hey, what are my tax savings that might be available to me? We're happy to run those initial numbers. We usually turn those around in just a few days and get you some initial numbers. All I need from you is the month and year you bought the building, the cost, the type of asset, and then also the address. And if you want to email that to me or give me a call, we can get moving on that. And like I said, we'll run you a benefit analysis, free of charge. And we want you to save somewhere between 7 and 10x your investment with us. So if we're charging you $2,000 for a study, we want you to save, around $20,000 on your taxes. And so we'll run the numbers to make sure we're going to hit those numbers. And then you can decide with your CPA or with us and your CPA how to best implement that. These studies usually take about 30 to 40 days to complete. Like I said, the price range is anywhere from about $2,000 for a single family rental home up to, $100,000 for a ski resort that's got multiple lodges. And I know that's a big range, but most of our studies are down, anywhere from 2 to 10,000 is probably the majority of our studies. And you're going to get a huge return on that benefit. The other thing I want to state is you don't have to actually have these studies done by the end of this year. You just have to have them done by the time you file your taxes. So really you have until October of next year to get this cost segregation work done if you want to utilize it on your 2020 taxes, assuming you extend. So, yeah, happy to run a benefit analysis for you. If you guys have any questions, feel free to give me a call. John, hopefully I stayed within my time limits there. I think I did pretty good. But if you guys have any questions, again, feel free to give me a call. Use me as a resource. I'm happy to strategize or talk with you and your CPA on how to implement some of these strategies, but we'd love to be a resource. And thanks, John, for having me.
No, appreciate it, Erik. This stuff is gold. And, I think a lot of people don't see the value of this stuff until they actually have, as they start cash flowing, making money, getting properties, and then they really start paying attention to taxes, because taxes weren't interesting for me, before you start accumulating stuff. And then you start saying, wow, this stuff is really interesting, because it's almost like, yeah, you pay you guys, but the amount you get back is substantial, and it's money sitting on the table. It's work that you guys are doing. Like I could pay you and the CPA and go sit on the couch and do nothing, and you're getting money back. You're making money. So, and like you guys are saying, it's at a no cost. So you're analyzing your property, you're telling them beforehand, hey, this is what we can get done. I mean, it's a no-brainer why people shouldn't be doing this. So
it really is. It's probably the easiest job I've ever had, to be honest with you, John, because it's just a numbers thing. It's like it either makes sense or it doesn't, and we'll run the numbers. We'll see if it makes sense. If it makes sense, you move forward. If it doesn't make sense, the nice thing about cost segregation is it's flexible. You kind of keep that card in your back pocket until, like you said, John, until you have a big income year and you got to write $100,000 check to the IRS, and then you say, hold up, let's do the cost segregation work this year. And so we run the numbers. Like I said, it's just it's just simple math to say, does it make sense? Am I going to save money? Do my savings outweigh the cost of the study? And if it makes sense, you move forward. If not, no harm, no foul. And you, like I said, you just hold it in your back pocket and you utilize it when it does make sense. So,
right.
Good point there.
And generally, especially if you have a handful of properties, or you even said maybe you work with another person and, you kind of do a bulk thing, that can maybe be done too. But I mean, again, a lot of people are forgetting that, a dollar today is worth $1 tomorrow. And the way you could grow that money in that time versus, waiting multiple years and years to get your money back at a slow pace, it can be, detrimental. So everyone knows having money today, you could do a lot more with than in the future. And that's a huge deal. As far as one question I had for some people, if they can't do the carryback, they may not make enough income for this year. It sounds like they can carry it forward for a number of years until they can use it, right?
Yep, that's exactly right. You don't ever lose these deductions. So what you don't want to do, John, is you don't want to pay us to accelerate them if it's going to take you 10 or 15 years to use them. Just take your standard deduction and you'll be fine without paying for a cost seg study. But if you have, if you can use the deductions in the first 2, 3, 4 years, you're not going to lose them. They just carry forward, and not, it's nice not to pay taxes on that income for those first 3 or 4 years.
Yeah, and for me, paying $1 in taxes is too much, and I know obviously a lot of people come to you guys because they dislike taxes, and you're still working within the law, but anything you could do to get money back faster or not pay is definitely much better. And it's good for people to consider those things, because you may change your job in the future, so you could take more from that time. You can obviously start to make more income, and you'll be able to have deductions to lower that basis there where they start taxing you more. So definitely things to consider. So other than that, we got your contact information. Again, everybody, I highly encourage you to contact Erik. He's been super patient with me. I asked a lot of questions, been really helpful. You guys can see this is a free class in cost seg, or the benefits that a lot of people don't know exist. This is huge. There's so much money that's been saved and returned back to investors with cost segregation versus just taking normal depreciation. It's insane how much, because we do syndication ourselves. And before I knew you, Erik, sorry, we did a cost seg, but people are amazed at how much they got back on their taxes after a cost seg's done. It's actually kind of amazing. And that's why a lot of people want to do one of these studies a year or on multiple of their properties, because you're going to lower how much you have to pay in taxes if you can do these every year. Obviously you have to keep accumulating properties, but I mean it's huge. You could get tens of thousands of dollars back based on how much your cost seg is. But it's super powerful tool. And that's something that we're definitely going to be thinking of you in the future. A lot of people aren't going to stop acquiring property, and it's hopefully, we have things lined up to where things don't, change too much and it won't make it beneficial. But I don't really see that happening, because as we know, a lot of people in government own real estate.
Yes, they do. No, that is very true. So I don't see it changing much. I think, depending on how the election goes, we might get rid of some of the bonus depreciation. But then if that happens, the tax rates are going to go up. And so, cost segregation is going to be that much more powerful, because you're going to be paying taxes at a higher rate. And so you're going to need those deductions so that you don't have such a big tax bill. So, hopefully they don't go up too high, but that's kind of what we're seeing. And depending on, like I said, who gets elected, I don't think cost segregation is going to go away. Accelerated depreciation is not going to go away. It just might be how fast we can accelerate it or how powerful it is. But again, if that happens, my guess is the tax rates are going to go up. And so you're going to need these extra deductions, because you're going to be paying taxes at 39 or 41% or whatever the tax rates are going to be. So definitely keep it in mind as we get through this election period to see kind of how this all shakes out. The good thing, my hopes are, I was going to say, if the thing is if one side or the other doesn't run all three, then nothing gets accomplished, in my experience anyways. So, if the Democrats were to win the presidency but not the Senate, I don't think there's going to be a whole lot of changes happening unless, one side or the other runs all three of the branches. So anyways, I think that, there's a slim chance that could happen, but we'll see. We'll see how it all shakes out.
Yeah, things tend to balance out, with obviously rates and purchase prices, stuff like that. When you're with rentals, but again, sometimes you get benefits that if you have got it done, you know, sometimes they make laws to where you can go back and take extra deductions and stuff like that. So it's definitely not going away. It'll fluctuate, but it most likely will always be beneficial the way I see it. Because,
no, you're right.
Again, you're leaving money on the table if you're not doing this, and it's a huge thing that doesn't require you to necessarily do more work. That's where you guys come in and specialize, and you do the work for the people, and that's huge. So again, really appreciate it, Erik.
Yeah, thanks, John.
This was really in-depth knowledge of this, and I know this will benefit a lot of people being able to see this on the screen, and I'm sure they'll be giving you a call. So again, appreciate everybody. Hope you get some benefit out of this, and Erik has his contact information there if you want to give him a call. Like I said, he's really easy to work with, and he's always been available when I called him. So thanks again, Erik. Appreciate it. We'll let you go on your way.
Have a good one.
And have a good week.
All right. Thank you. You too.
Thanks.
Bye-bye.
Bye.